Hey, what's up guys? John here. It looks like we're going to start to see a wave of bank bailouts all throughout America and the world in the next 30 to 60 to 90 days. I believe we were in the biggest bubble that we've ever experienced across all assets the last couple of years. And I think that is going to be, that's going to be probably one of the biggest bubbles that we look back on and say, wow, I can't believe we thought that was normal. Whether it be commercial real estate, residential real estate, even auto loans. People are paying 30 to 40% over sticker for a car. People are spending $1 million on a JPEG. People are investing in putting all their money on like some dog altcoin. I'm not, some people make money, sure, but at the end of the day, it was speculation. But what we're starting to see is we're seeing this mania start to leave, and people are starting to get a little bit more concerned. Look at Ken Griffin, for example. He is one of the most successful investors, hedge fund managers ever. Last year he made $4.2 billion. He made $2 million an hour in 2022. It's unreal, right? $2 million an hour. And he came out and said capitalism is breaking down. It's breaking down. And he's talking mainly about the SVB bailout. Now, what I think is going to happen is I believe when they came out and said last week that they'll issue a $2 trillion backstop on other banks, I believe we're going to start to see massive inflation. And I think also they're going to continue to increase interest rates. So how is this going to work? If they are going to increase inflation, potentially, and they're going to increase interest rates, it means the dollar's worth less and it costs you more to service existing debt. Whether it be credit cards or auto loans, any adjustable rate debt, it's going to get more and more expensive. But yet incomes are likely going to continue to fall as we continue to see more and more and more layoffs. So I look at the model of like a Charlie Munger or Warren Buffett when they say that they'd want to buy great investments and hold them forever. Now, if you're buying something like a real value investment, you're buying something based on true intrinsic value, then you'll be fine. You'll be able to withstand the storms. But when you're investing on speculative things like JPEGs and stuff like that at all-time highs, then it gets a little bit more challenging to make long-term generational wealth for most people. Some people get lucky. They'll buy something, they made a really well-timed investment, and they sold it at the top. That's great. But what's going to happen, I believe, is we're going to be stepping into a moment in time where investors, smart and savvy investors, are going to be able to make a ton of money due to the amount of fear that is going to be injected into the market due to what's happening right now with banks. They're talking about nearly 200 banks at risk of the same fate as SVB. Look at the bank's business model and look at what's actually happening. And by the way, today's video is sponsored by GreatCreditFast, the company I own. We help investors and people that want to invest in real estate but have bad credit fix their credit so that they can position themselves to get funding. So if you need help fixing your credit, we would love to help you at GreatCreditFast.com. It's GreatCreditFast.com. This is also a great time to do a balance transfer and get out of high interest credit card debt. Also, when stuff like this happens and banks start to fail, you're going to start to see stricter and stricter and stricter lending requirements. So you might see less options to do balance transfers, in say 6 months or a year than you will today. So this is the time to fix your credit. We'd love to help you at Great Credit Fast. Our phone number is 561-430-5900. So take a look at this. So UBS, they get bailed out by Credit Suisse. And what's crazy here, $3.2 billion. What's crazy is the Swiss government steps in. Swiss National Bank steps in. This is absolutely crazy when you factor in that a third of all wealth is held in Switzerland. A third of all wealth is held in Switzerland. When you have the Swiss government stepping in to try to help, that's concerning. And yesterday, this came out, coordinated central bank action to enhance the provision of U.S. dollar liquidity. So, Bank of Canada, Bank of England, Bank of Japan, European Central Bank, and the Federal Reserve, and the Swiss National Bank are today announcing a coordinated action to enhance the provision of liquidity via the standing U.S. dollar liquidity swap line arrangements. Think about that. To improve the swap line effectiveness, providing U.S. dollar funding, the central banks currently offering U.S. dollar operations have agreed to increase frequency of 7-day maturity operations from weekly to daily. These daily operations will commence on Monday, March 20th, 2023. It will continue at least until through the end of April. The network of swap lines among these central banks is set to be available standing facilities and serve an important liquidity backstop to ease strains in global funding markets, hereby helping to mitigate the effects of such strain on supply of credit to households and businesses. Supply of credit to households and businesses. If you look at where banks really stand right now and where the actual consumer stands, consumers, I mean, their income's not growing. In many cases, actually falling. And when you have a situation where you have rampant inflation, you have $1.69 trillion in almost $1.7 trillion in outstanding auto loans. And many of these auto loans are purchased 30 to 40% over sticker price. And they put 5-10% down on these cars, so they're underwater. These banks are underwater on these loans. You have that situation unfolding. You have the residential real estate that's in trouble. A lot of markets are already starting to see very, very, very big softenings. But what's crazy there is that the average down payment for first-time home buyers was 6%, and the average down payment for second-time home buyers, was 13%. So an average, let's just call it, of 9%. The cost of sale, like if you wanted to buy that house and sell it, you'd probably have 5% to agent fees. You know, some markets are 6%, but say 5%, 2.5% to the listing agent, 2.5% to the buyer's agent, and then you have title, and maybe transfer taxes. Maybe the sale is 6%, 7%. So if you were to buy the property and sell it for exactly what you sold or you purchased it for, you would break even. But that's based on mortgage rates were at 3%. And now they're 7%. Odds are people aren't going to have the money to even sell their properties. But what's crazy is the scale of which problem, or how big of a problem that really is. Because 40% of all mortgages in America were from 2020 to 2022. So almost half of all mortgages in America were taken at the height of the market. And these banks are holding these loans. So you think about it. Banks are holding the auto loans. They're holding residential real estate loans. They're holding credit cards. It's 970 or 980 billion in credit cards with defaults continuing to rise. You have commercial real estate. Commercial real estate is such a huge problem. No one's talking about this. And I'm gonna dive a little bit more into this right now because Saudi National Bank, this is over the Credit Suisse situation. They lost $1 billion, right? But I was looking, it reminds me of this, right? People that have purchased these bonds. These $17 billion worth of these risky bonds are now worthless after the UBS takeover. This situation brought this company, Pacific Investment Management Company, PIMCO, back into the light, right? This company, PIMCO, they purchased this building, a chain of buildings valued at $3.9 billion just a couple of years ago. They took out a loan for $1.7 billion, so they put $2.2 billion down. Like, that's a substantial down payment. Right? You're going to put over 50% down on nearly a $4 billion real estate portfolio. And they can't make their payments. And so it's like, okay, well, if a company that has that kind of cash on hand that could put a couple $1 billion down, they can't make their payments. How big of a problem is this commercial real estate problem? Well, it's a $20 trillion commercial real estate. That's where stress is. Like, they were talking about this, just came out 7 hours ago. $20 trillion, and half of the $20 trillion in loans are floating rate. So you have half of all of these loans that are floating rate. So commercial real estate, if we look at what's happened last 3 years, you have the work from home phenomenon. Everybody is working from home. They're reducing their office square footage. They're trying to reduce expenses. And so as that's happening, there's more and more vacancies, meaning that there's more supply than there is available demand, meaning rents usually coming down. And so if rents are coming down and mortgage rates on these properties, half of which are floating rate, went from 3% to 7%, and property taxes and insurance are going up, what are you going to have? You're going to have a disaster in the commercial real estate market, all of which is mainly sponsored by a lot of these big banks. A lot of small banks, medium-sized banks, big banks are holding that debt. And so as that begins to happen, you just have to ask yourself, where do banks make their money? The treasury yields are 4%, 5% in some cases. People are taking their money out of the banks and buying treasuries. So banks are sitting on tons of bad debt, and they're sitting on less deposits, and they're sitting on a really dark spot. And a lot of consumers are sitting there wondering, are banks going to fail? I mean, you're seeing these headlines. People are looking at this like, okay, 200 banks at risk. People are doing like bank runs. Not full-fledged. I'm not saying you should, but I'm just simply saying people are getting scared. They're taking money out of banks. They're taking some emergency cash out. And as that's happening, look at Amazon, right? Amazon is to lay off 9,000 more workers. Meta last week, another 10,000 workers. And Jerome Powell's talking about another hike, right? Another quarter-point hike. And so all this is happening. You have to ask yourself, where are banks going to stand in the next 6 months? I think what we're going to start to see is a lot more fear being injected into this market through the mainstream media. And this fear is very contagious. People will look at this and say, oh, this is going to happen and that's going to happen. And they do something impulsive. And, that's kind of it's kind of assumed when they start putting out these headlines. People start getting very, very concerned. They start seeing these banking collapses. But when you start to have these situations become more and more and more common, I think the likelihood of people, pulling money out of their banks and people getting more defensive is only going to continue to increase. And I also think that we're going to start to see more defaults occur across, and more losses occur across these banks than ever before this year. But huge opportunities, though, coming for those that are smart and prepared, that have the flexibility. I personally believe great credit is going to be so important in 2023. And the reason for this is that banks tighten up funding when the economy starts to get more concerned. And if you have really good credit, there's a higher chance you're going to be able to get funding. If you have a 600 credit score, a 650 credit score, a 700 credit score, it's going to be much harder to get that loan versus if you have a 780 or an 800 credit score. This is the time you want to get out of high interest consumer debt. This is the time you want to position yourself to be able to withstand a rainy storm ahead. You want to position yourself. Like if you have a really, really, really nice car with a huge monthly payment that maybe you can afford, maybe you can't, it's probably a good time. If the market's still hot, you can get out from underneath that car and get something a little bit more affordable, something easier to maintain, something less costly to insure, maybe cost you less gas. Like that would probably be a smart move. Reducing your expenses on adjustable rate debt is going to be a very, very smart move. Sitting on more liquidity, sitting on great credit, positioning yourself for uncertainty is going to be the smart move. What do you think about this entire situation? Drop below, hit the like button, subscribe here. Subscribe also to my second channel, Interactive Call-In Show. And for short form content, Instagram, you can click the link in the banner. Catch you guys over there. And again, if you need help fixing credit, we'd love to help you at GreatCreditFast.com. Catch you guys later.